In this video, we're going to try and decode the insurance industry and understand some of the basic features of this industry. This is a unique industry, and it's not simple to compare this industry with some of the other industries that we come across. As an industry structure, this characterizes an oligopoly where some of the top players, the top 5 players, actually account for about 85% of the market share, both in terms of volumes of policies sold and in terms of the value in terms of the premiums that are there. The top players would include the likes of LIC, SBI Life, ICICI Prudential Life, HDFC Standard Life, and the industry is sort of top heavy on that context. This is a slightly different industry where the product is sort of pushed. That's because human beings do not assess risk well, especially when it comes to themselves, and do not think about adequately covering risk in that context. So they don't go ahead and buy these policies on their own. The policy has to be essentially sold to them, which is also why you will see that most of the life insurance company advertisements that you see on the screen would typically be appealing on the emotional side of the purchase to the buyer. And that's the nature of the industry that we look at. Because it's a push product, it gives a big advantage to an entity who has a banking license with themselves, right? Because with a banking distributor ally who's available, there's access to a large customer data, there's access to a large customer base, cross-selling is a possibility. It becomes easier to kind of go ahead and pitch this product to an existing customer. And that's why you'll see that the top players are usually the ones which are likely to have, a banking license along with them. It's a longer duration product, which is essentially, it's a product that kind of runs over a 20-year period, and which is why it is difficult to kind of evaluate this product or this company or this insurance sector similar to some of the other sectors. In other sectors, you'll see that, whatever you sell on an annual basis, you're going to see the profitability of that in the near future. But in insurance, if you sell a policy today, your actual profitability might be years ahead. So in that context, it's a slightly different kind of an industry to analyze. Interestingly, the concept of this product in India would be, you would want to kind of look at the risk cover as the first idea around buying an insurance product, followed by the fact that it gives you some kind of a tax advantage, and you can also use it as a savings. However, the actual way it is sold is the exact opposite, right? It's sold as a product that gives you savings or investment and gives you a tax benefit. It's almost as if the risk cover is just incidental to the entire activity. That's how it is sold. Of course, with a little bit of awareness creation and the way technology has moved in, it's allowed people to kind of become aware and start using insurance only as a risk cover product now. But historically, the sales have been kind of in this order. There are some industry specific terms that you would want to kind of also cover. So as I said, this is a longer gestation product. So when you evaluate a company, you evaluate them on certain specific terms. For example, the embedded value. Now, what do you mean by the embedded value? This is the present value of the profits that you will derive out of all the policies that are in force today. So you sold all the policies in the past. As of today, all the policies that are in force, the profitability that you will generate out of these over the future, present value of that is what is called as embedded value, right? VNB is value of new business, similar to the embedded value concept, but for only the policies in this year that you have sold. So the new business that you have done, what is the value of that? That's VNB. Now, companies differ in terms of the kind of products they sell. Some companies sell products where the premium collection is annual. Some companies sell products where there is a single premium collection that can happen, right? So depending on what is your product mix, your premium collected could be very different. It's difficult to compare these kind of companies then. So you use a term called annual premium equivalent, or APE, which then standardizes this premium across different kinds of firms to understand how much is a company kind of gaining market in terms of this annual premium equivalent. For example, LIC sells a lot of policies which are single premium in nature. So their initial premium looks bloated in a year, but then for that policy, they're not going to get any premium in the future. Their market share in terms of total premium collected is about 70% for incremental policies as well. But when you look at it on an APE basis, that number falls to around 40 to 45%, right? Market share. Then we talk about persistency. As I said, it's a longer duration product. People keep falling off in the life cycle of the insurance product because for some reason they don't feel the need beyond a point. So they do not continue with the payments of premiums of their policies. So you calculate persistency, which is how many clients or premium paying customers have persisted for an insurance firm beyond the first year, the second year, the fifth year, and so on and so forth. That's basically what comes under persistency. The industry itself is an interesting one in the sense that the way the product is sold, if you look at the value chain, the insurance product company can directly sell it to the insuree or the customer like you and me. They can also go through a bank, they can go through a broking channel, they can go through one of these insurance aggregators. So a lot of these channels have started kind of coming up in the recent past. Let's look at the industry in terms of the kind of products that are available. If you look at pure protection products, which is only risk cover, then you have something called as term plans or term life, and health insurance is also in a similar context, so I have kind of classified it here as well. If you look at savings or investment return kind of products that you're looking at, that then further gets divided into two components. Some of those are called as unit linked. These are policies where when you pay a premium, the premium is essentially invested into underlying securities, and that behaves just like a mutual fund. So essentially this is what we commonly call as ULIP, right? Then there are non-linked policies, which are also kind of known as traditional policies, where you can have a segregation as participating and non-participating policies. Participating policies are the ones where the underlying investments, whatever is the return, some portion of those profits that the insurance company has generated is given to the policyholder as well. Non-participating is sort of a fixed return product. For example, you would have come across these products that will say that, give this premium for 10 years and then in the 15th year you're going to get such and such amount at the end of it. Right? That's a non-participating product. If you think about it, the risk for the insurance firm is highest in the non-participating product because they have defined what they are going to pay at the end. Right? However small that return be, the outflow is defined. So the entire risk is on their balance sheet. On the contrary, if you look at something like ULIP, the value that you're going to get out of that is what happens to the underlying portfolio. So the insurance company is not really taking any kind of risk there. Right? So consequently, there are features that are available there. Within this framework, there's also a difference in terms of, how you are selling the policy to a group or you're selling it to an individual. What we commonly come across is the individual scenario, but in a corporate plan, for example, you could have a corporate covering all its employees for life insurance. That's a group policy that is sold by insurance companies to a corporate. Usually the margins are higher in individual policies as compared to the group policies that are there, right? Now, given the value chain, it defines how a company basically sells their products and what kind of products they sell. In these products, the highest margin products would be something like a term life, followed by the non-linked ones, and then the lowest margin product is ULIP. So you will see that somebody who has a bank license probably has a better possibility of selling bigger chunk of ULIPs purely because they have lesser distribution costs. If you do not have a banking license, on the other hand, you will have to pay something to the intermediary to get your policies sold to customers, and in those cases you will find those companies would have a higher proportion of non-linked policies in their overall policy pool that they are selling, right? So those are kind of understandable. SBI Life, for example, sells about 60% of its total premium collected is through ULIPs essentially, right? Let's talk very quickly about the industry a little bit. So if you look at a term called life insurance density, right? Industry is density, which is premium collected in USD per capita essentially, right? This for India is about $60, which is significantly lower as compared to some of the other economies. If you look at another term that is commonly used, that's called as life insurance penetration, right? Which is premium collected as a percentage of GDP. That's effectively 3.2% for India. It appears to be low, but the reality is this number is around this range for most of the other countries as well. If you look at a US, they'll be at 3%. If you look at a China, they'll be less than 3% in that context. So we are not under-penetrated when it comes to life insurance, right? However, we are sort of under-insured because on a per capita basis, people don't have adequate risk cover that they carry. So that's something that drives this industry. That's something that is going to take this industry ahead in the future as well. It's an industry that is also growing more because of increasing awareness and information about financial products and risk management. As you teach more people risk management, they will understand a little bit more with respect to life insurance. One of the core tenets that you need to follow in terms of financial management is one life insurance cover and one health insurance policy is what everybody should have. I think this awareness is leading to the growth of this industry. That's it in this particular video from me. Thank you.